As you'd expect, we've given that close consideration. We understand how much our customers and the broader community are looking forward to rate relief. But hopefully, as you'll also understand, I can't announce what we might do next week, but other than to say we're, of course, acutely aware of how much our customers would be looking forward to rate relief.
And what factors would you be considering when you consider how much of any future Reserve Bank rate cuts to pass on?
There's always a lot of factors in terms of that are taken into account in terms of funding, changes in the market, etc. This is, of course, a rate cut that has been contemplated for some time. Of course, we've given consideration to what might occur. I think the market's pricing in about a 95% chance of a rate cut. I don't think it's that certain, but we do believe that the return to inflation and underlying inflation, importantly going into the target band, hopefully gives the RBA scope to be able to reduce the cash rate.
Now, you told analysts today that you're seeing improvements in household finances and a reduction in hardship. Just how many customers, though, have been in financial distress with CBA over the past couple of years?
Yeah, well, to give you a sense, in the 6 months we offered 65,000 financial assistance sort of support packages. Now, they can often be short duration. Someone might need help or relief for a couple of weeks, sometimes up to a month. So it gives you a sense of the overall scale. Of course, what we've seen is a lot of pressure on household budgets in particular over the last couple of years, offset by low unemployment, but also, as we saw, particularly after mid-year, we started to see some of the benefits of the Stage 3 tax cuts come through, some of the energy rebates. So that did see an improvement or an increase in savings and somewhat of an improvement in household disposable incomes. We think this is important, obviously, as inflation continues to come down, albeit prices across the economy are up 20% over 4 years. So it's perfectly understandable that many households are feeling that their budgets are stretched.
And how much of that hardship related to mortgages?
About probably 2/3 of it related to mortgages, and of course alongside that is consumer finance, which includes like personal loans, credit cards. But overall, relative to what we've seen over many years, the number of customers that are actually behind in their repayments is very low, and sort of well below in terms of what we would otherwise expect at this point in the cycle.
But what would you expect might happen to mortgage hardship and arrears and forced sales if the Reserve Bank surprised and didn't start cutting interest rates next week? Yeah,
look, it's a little hard to determine. I mean, if you think about the 6 months to 31 December, there was a gradual sort of improvement from mid-year. It probably improved slightly more than we would have expected, and financial assistance packages that we were just talking about, they were down 15%. But I think all things being equal, you would expect a gradual deterioration over the course of 2025 if there wasn't rate relief. Notwithstanding, prices are starting to stabilise. We're continuing to see wages grow across the economy. There's no question. I think probably more as much from a sentiment perspective. I think from our perspective, many customers were frustrated during last calendar year because the prospect of interest rate reductions were sort of pushed out, obviously, into the following year.
And what do you think will happen to house prices if the Reserve Bank does indeed start cutting interest rates next week?
Yeah, I think there'll be a modest increase. The housing market has performed pretty strongly overall. I think many people were anticipating when rates started going up from 10 basis points to 435 basis points that house prices would come down. They actually increased over that period of time. What we did see, particularly in the last quarter of last calendar year, so October to December, a softening, particularly in Melbourne, to a lesser extent in Sydney, and then actually price appreciation in other markets like Brisbane, Adelaide and Perth.
And you've noted in the analyst briefing a lot of economic weakness in Victoria.
Yeah, I think Victoria for us across a range of different indicators, and from what I've seen with other public businesses, is a bit softer than the other states. I think both sentiment and also just economic activity is weaker relative to, as I said earlier, a number of the other better performing states.
Now, in housing, well over half your lending is going to households on incomes above $200,000 a year, and a lot of that's for property investment. Does that signal the end of the dream of home ownership for middle income Australia?
I don't think so, and I think it's really important that it doesn't. And as your question's touching on, I think it's a really important aspect of what's both socially and financially has served people well here, which is access to housing over a long period of time. There's no question over the last few years, particularly as there hasn't been enough supply to coming onto the market to keep pace with the increasing population. You saw a rapid increase in terms of the interest rate, which of course reduces borrowing capacity. So I think it has made it harder, particularly for first home buyers, to gain access to the market, sometimes to save for the deposit, but also to be able to afford the upfront purchase price. And so I think as rates come down, as there continues to be a lot of focus on adding supply into the market and affordable supply, hopefully that the dream, and I think the important aspect of what we've been able to provide for future generations and to be able to own your own home is kept intact.
How much of a role, though, have the major banks in particular played in pushing up house prices with increased lending?
Well, I think the research that I've seen would indicate very little. I mean, I think the biggest driver of a change in house prices is not enough supply and, of course, ongoing and continuing demand. I think one of the challenges for financial institutions is, of course, as the cash rate's going up and we're basically testing what we would call serviceability, or whether ability for a customer to repay their loan, it's at a much higher interest rate than it was a few years ago, which obviously reduces the amount that we can lend. That's just making it harder for people who are, let's say, less established, don't have an existing property, to gain access to the market. So I think you'll see financial institutions will be able to support more customers as the cash rate comes down.
Now, more than 60% of new migrants bank with the Commonwealth Bank. That's a large growing source of very cheap deposits for bank funding. To what extent is the bank, borrowing from the poor to lend to the rich?
Yeah, again, not at all. So more of our new customers come from non-migrants, but of course, if we think about what are the new entrants or what are the sources of customers, it's the youth of Australia, which still make up a higher proportion of our overall new accounts. And then, of course, migrants, which I think have been an important economic growth story for Australia. We want to be able to support both of those groups of customers, and we've been doing that for a long time, and we intend to continue to do exactly that.
Also a big factor in the demand side on the property story, though, in terms of house prices.
Well, I think what you see with people who are migrating to Australia, it's more than 80% actually go into renting, which of course there are capacity constraints in terms of the rental market as well. It does come back to that sort of fundamental position or problem, is you have to make sure that there's enough supply coming onto the market at various price points to be able to support ongoing population growth. And we are, as you know, heavily concentrated in a small number of, notwithstanding the vast geographic nature of Australia, most of the population lives in large metropolitan areas.
One analyst described CBA to me as the most expensive bank in world history, with a share price to earnings ratio approaching 30. Where is your future growth in earnings going to come from to justify that share price?
Yeah, there's a couple of things within that. First of all, for owners of the Commonwealth Bank, obviously they care about the share price. They also care about the dividend, which is the income that we can return to them, and for an Australian owner in a fully franked nature. We don't spend a lot of time per se looking at the share price or worrying about it. What we can control is making sure that we've got a very clear strategy. We're doing a great job supporting our customers. We can continue to grow, and in the last 6 months to 31 December, notwithstanding the challenges that we've been talking about, it's the strongest growth we've had to lending to both households and to businesses. So we believe if we continue to support our customers, the community and the broader economy, the growth will come. Now, the valuation, of course, will be a judgment that many other players will make, and we're happy to leave that to them.
You're sitting on a big pile of capital. Are you planning to do anything with that capital, or as some analysts suggest, maybe even raise more capital while your share price is high to fund some expansion?
Yeah, there's a couple of things for financial institutions. One, you have to have a regulatory minimum of capital, which is effectively set aside so that you can absorb any unexpected losses that might occur. Yes, we're above that. Probably the most effective way to use that capital, which we did, is increasing our lending to, in this case, households and businesses. A second effective way to use that capital is to invest. We increased our technology investment to record levels, up 11% in the half. Then, of course, we can return that capital through dividends, which today's $2.25 fully franked dividend is exactly that. And, of course, as you said, we've got capital. It gives us flexibility to be able to support the economy if there's a deterioration and to be able to continue to support growth.
You're 50 this year and you've already been running the Commonwealth Bank for 7 years. What does the future look like for Matt Comyn?
Well, I'm just going to continue to do the best job I can every day supporting our customers, leading the company and navigating through whatever both economic conditions await us, but making sure that we're setting the Commonwealth Bank up as best I possibly can.
Absolutely. No plans to leave?
Not at this stage.
Matt Comyn, thank you for joining the business.
Pleasure.
Cheers.
Cheers.